Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront, and generate consistent returns year on year. So the first thing you want to do is open up your brokerage platform and navigate to any equities underlying, and then you want to pull up a list of expiration dates, options expiration dates for that underlying. The purpose of this step is to lock in on an expiration date that we can use moving forward for future positions. So the one that we need to choose has to be a monthly expiration date, not a weekly or quarterly, and it needs to be between 30 and 60 days out in time. The only expiration date that currently fits that criteria is January 17th, which is 44 days out. So we can take that information, come over to our watch list, and simply filter out any and all underlyings that have earnings over the next 44 days. And we also want to filter out anything that has a low liquidity rating level, because we only want to be trading tight spreads. We want to be able to get in and out of positions easily. And the reason why we filter out for earnings is because earnings will increase volatility, it will mess up our deltas, and these things will have a negative effect on our P&L. So we want to avoid that. Now, this is just a futures watch list. We're not going to be going over futures today. Let's just go to a high options volume watch list. It's a pre-made watch list. You can use whatever watch list you like. And I personally like to order everything from high to low IVR. The name of the game here is to sell when volatility is high and play the contraction back down to the mean and hopefully further below. So that's why we like to do that. Now, we go down the list and see what would fit well inside our portfolio. Make sure you're nice and diverse. Don't be too heavy in any one sector. Just use common sense and you will be fine. So just looking at the list here, we've got EPD currently trading at just under $33. It's got an IV rank of 71, an absolute IV level of 19.3%. So if we have a look at EPD and we go over to January 17th, we will now be presented with the options chain. And here we can simply do what we always do, which is sell one call and one put. And we want to sell the call and put anywhere between a 15 and 20 delta. Now, this is a good example because you don't always have the best strikes to choose from, especially with something like EPD. As you can see here, we've got 14 delta and then it jumps up to a 27 delta. So we have a decision to make here. Now, in this case, let's just have a look at the chart. So in this case, as we can see, we have had a bit of a spike in IV. It would have been better to have got in a couple of days ago. However, it's still not too late to get in. We've got a low of around 70, an IVR low of 70, and a high of around 105. So there's still plenty of room for contraction. So in this instance, we might be tempted to be slightly more aggressive and go with the 27 delta. Then again, you also want to keep in mind what the current VIX level is, which is currently at 13, which is pretty low right now. So the reason why that's important is because the chance of an adverse move happening in the market is a lot higher when IV is low. So you want to keep that in mind. Now, if you have a lot of positions in your portfolio and you really want to put a position on an EPD, you might be tempted to be slightly less aggressive and go with the 14 delta. However, if you are struggling to find positions and you just need to get some theta on, then by all means you could be slightly aggressive. So let's just go with a slightly more aggressive approach. And we're going to show you how you can manage risk effectively as well. So on the put side, we've got a 19 delta and a 35 delta. I think in this instance, we'll go with the 19 delta. And this essentially creates a range between 31 and 34. Those are our strikes. Now, we would collect $55 up front, and our buying power is going to be $500. Buying power requirement is going to be $500. So, not a bad return. It's a pretty standard return for a naked position. However, we did mention about obviously the VIX level being low. So, what we can do is buy another contract a little bit further out, just a dollar wide. In this instance, you can also go further out. That's completely fine. But a dollar wide in this instance, And what that's going to do is limit our loss. So our max loss is now capped to $1 minus the premium we collect, which is 29 cents, multiplied by 100 because each contract controls 100 shares of the underlying. And that gives us a max loss of 71. And our broker is only going to require what our max loss is in buying power, so 71. So we've reduced our buying power requirement. We've limited our loss. This is one way that we can manage risk. And we've given ourselves a higher return on capital. We've got a probability of profit of 54% and a probability of hitting 50% of max profit over the next 44 days of 77%. Now, IV is overstated in the market. Well, that is our view. That's our edge. That's the edge that we're trying to play out. And most of the time IV is overstated. So these probabilities in reality will actually be slightly higher. In my experience, anywhere between 5 and 15% higher. It just depends on what the market's doing. But all in all, this is a decent position for a small portfolio, very small portfolio. You only need $71 to put this position on. And that's how you can find and manipulate positions. So how do you know how much buying power you should be allocating to your positions? Well, in order to figure that out, we've got a position sizing template that's free for everyone to get a copy of. Link is in the description. And it will take you to this spreadsheet here. The way it works is you enter in the size of your portfolio. Let's say you've got a small portfolio of $5,000. You can then enter in what the current VIX level is, and everything below will then be automatically calculated for you with an explanation of what's going on as well. It will tell you the maximum amount of buying power you should be allocating to any single defined risk position, undefined risk position, and how much of your portfolio you should be allocating to short premium strategies in general. So as long as you follow this over the long term, you will be just fine. If you do want to learn in more detail about what we do and how we do it, link in description. This time click on EDS Premium, get yourself signed up, and inside you'll have access to our portfolios that will allow you to see in real time the positions that we're placing, how we're managing risk, the adjustments that we're making, etc. And there's also a full course, so no prior knowledge is required. You can learn the theory and see how it's applied in real life in real time. If you get stuck, it is, of course, a private community, so you can speak with myself directly and with other like-minded individuals. There's also a 100% money-back guarantee, so once you have studied our full course and followed our trades for at least 6 months, if at that point you haven't been profitable, then we will work with you for free until you are, or you can simply request a full refund, so it's risk-free on your part. And right now, it is only £1 a month to join. The price will be increasing. However, once you're in, the price is locked in for you for life, so you are definitely rewarded for getting in early. And with that being said, I will see you guys on the inside.